To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
So let's look at the next question, friends. A trader is having in his portfolio shares worth rupees 85 lakhs at current price and cash of rupees 15 lakhs. So there is some portfolio of 85 lakhs and cash of 15 lakhs. The beta of the portfolio, of the share portfolio, okay, the beta of the share portfolio is 1.6. So this 85 lakhs beta is 1.6. After 3 months, the prices of the shares dropped by 3.2%. Okay, after 3 months, they dropped by 3.2%. Okay, determine current portfolio beta. Okay, and portfolio beta after 3 months if the trader on current date goes for long position on 100 lakhs worth of Nifty futures. Okay, this is a very simple problem. Beta is already given, and what they are also saying is that after 3 months, the price dropped by some percentage. You are first of all required to determine the current portfolio beta. Portfolio beta. So, friends, do not confuse these words. Okay, first they have given share portfolio beta of 1.6. When they say portfolio beta, it is shares plus cash. Okay, then what they have said is portfolio beta after 3 months. So, the entire portfolio is beta after 3 months if the trader on current date goes for long position on 100 lakhs Nifty futures. So, 85 lakhs equity share portfolio is there, 15 lakhs cash is there. You also go long on 100 lakhs of Nifty futures, then what is the combined beta of all these three put together? That is the second question that they have asked. Okay, it's actually a very simple problem. We need not complicate it. Extremely simple. Put the numbers in a table, you will get the answer. Believe me, half of this particular chapter, derivatives valuation analysis, is understanding data, putting the data in a tabular form, following logically what is happening one after the other, step after step, you will get the answer. So friends, now let us first input the basic data what they have given, and then we can, as we discussed, we can start solving it. First, equity portfolio, rupees lakhs is 85, then cash, but also rupees lakhs is 15, total is 85 plus 15, which is equal to 100. The next piece of information that is given is that the beta of this portfolio is 1.6. So, what is the beta of this? Of this what portfolio? Share portfolio here. So, beta of this is 1.6. Now, if the beta of equity portfolio is 1.6, what is the beta of your cash? What exactly is beta? Beta is the variation or change in returns of a stock or a set of stocks based on variation or return on a market index or market. So, if the market moves by 1 and your portfolio moves by 2, then the beta is 2 by 1, which is 2. If the market moves by 1, your portfolio moves by 1.5, beta is 1.5 by 1, which is 1.5, correct? So, here equity portfolio beta is 1.6. Cash, will its beta change when market changes? Or let us say the index goes up and down, Sensex goes up and down, will the value of cash change? Especially in the short term, I mean forget inflationary aspects and all of that, value of cash does not change, right? So, beta of cash is actually equal to 0, okay. So, let me change that format. Beta of cash is 0. If beta of cash is 0, what is the beta of the total portfolio? It is simple weighted average. So, is equal to 85 into 1.6 plus 15 into 0 divided by 100. So, the beta of the portfolio is 1.36. Okay, this we just computed by just looking at the numbers. Okay, we have not even gone to solving the problem. Determine the current portfolio beta, we already have it, 1.36. Very simple. So, the first answer is given. Beta of the portfolio is 1.36. In the explanation what you give, you actually have to write beta of portfolio is equal to weighted average of beta of respective components, that is 85 into 1.6 plus 15 into 0 whole divided by 85 plus 100, okay, that is equal to 1.36. You have to actually write it like this. Okay, we finished the first part of the question. What is the second part? Portfolio beta after 3 months. Okay, after 3 months, what has happened? Okay, if the trader on current date goes on long position of 100 lakhs of Nifty futures. And also second piece of that information that is given is after 3 months the prices of shares dropped by 3.2. Okay, so now 3.2%. Now let me write part 2. First, prices of shares. When I say shares here, this share portfolio, prices of shares or equity portfolio, equity shares, okay, dropped by 3.2% after 3 months. What is the meaning of this statement? It simply means that when you have a market or an index and you have a portfolio, the linkage between these two is beta of 1.6. The portfolio dropped by 3.2. So, how much would the market have dropped? Getting the point? There is a market index, there is a equity share portfolio. The linkage between these two is if the market comes down by 1, this will come down. What is this? The equity portfolio will come down by 1.6. If this has come down by 3.2, how much has the market come down by? 3.2 by 1.6, actually 2%. 2% is the reduction in the market. Consequently, because of the beta being 1.6, the entire portfolio value dropped by 3.2%. So, this fell by 2 and hence this fell by 3.2 because the beta is 1.6. Now, it is not on the face of it, it is not implied, but you have to understand it from the information given. So, let me say, given beta of portfolio is 1.6, the market index dropped by 2% in 3 months, that is 3.2% divided by 1.6, or you can make it further simplify and say portfolio beta is equal to 1.6, change in portfolio is equal to 3.2%. It is negative, right? 3.2% drop implies change in market is equal to 3.2% divided by 1.6, that is equal to 2%. Okay, you can probably write like this also. This I wrote it in sentence form, here I wrote it in a step by step form. This gives us the drop in market by 2%. Now, what is the other point that he is asking? What is the second part of the question? Portfolio beta after 3 months, if the trader on current date goes for long position on 100 lakhs of Nifty futures. So, we have now additional event which has happened, which is equity portfolio 85 lakhs, you have cash 15 lakhs, you have Nifty long. What has the person done? What has the trader done? On current date, he goes for long position of 100 lakhs of Nifty futures. So, Nifty futures long is 100 lakhs. When you go long on Nifty futures of 100 lakhs, what is Nifty? Nifty is a market index. So, what is its beta? Beta is 1, market is 1, right? That is what we are saying all along. This we know is 1.6 beta, this we know is 0, and this we know the beta is 1. Now, here your investment is only this 85 plus 15, which is 100 lakhs. But you have entered into a derivative contract to buy Nifty futures after 3 months at 100 lakhs. As on that date, it is the derivative is part of your portfolio, but the total portfolio value is 100 lakhs plus profit or gain on the derivative contract. And what is the profit or gain on the derivative contract? The profit or gain on the derivative contract is linked to the movement in the value of the derivative or movement in the value of Nifty. So, if you look at this, right, beta of portfolio is 85 into 1.6 plus 15 into 0 plus if this any change in the value of the index, you get a profit. So, entire profit is attributable to you. So, even though that 100 is not part of your portfolio, the profit on 100 is part of the portfolio. So, you see, In the numerator, when you compute the beta, you will actually take it, or when you multiply the betas, you take weighted average of betas. In the denominator, when you compute the total value of the portfolio, you do not take it. So what do I mean by that? So here you do 85 into 1.6 plus 15 into 0 plus 100 into 1, because this is what is your exposure to the market returns, divided by what is your portfolio size. Your portfolio size is 85 plus 50. You do not add 100. Why do you not add 100? Because 100 is a contract. 100 you do not have the asset. Whereas the returns on that 100, you have the right to enjoy the returns, whether it is profit or loss. But the base 100 is not part of your overall portfolio. Only the returns are part, which is why you are not dividing it by that value. Right. So if let us say I put a bracket on this, so beta of the portfolio is actually 2.36. It is very, very simple. Now you tell me, in this entire thing, did we require actually any information, or is there any use of change in market the 2%? Is there any use of the 2% what we computed? Actually there is no use. Had they asked, okay, what is the reduction in the value of the portfolio after 3 months, then we could have used 2%. How will you use 2%? So what you will do is, here there is a 2% change. So you will put here minus 2%, then you 0, here you will put minus 3.2%. And then you will say the total change in the portfolio value is equal to 85 into 1 plus 3.2, that is 85 has come down to 82.25. Will there be any change in cash? No. Will there be any change in Nifty futures? Yes, there is a loss. Okay. So what will happen to your total portfolio gain or loss is, you will do 85 minus 82.28 plus 15 minus 15 is anyway 0. So 100 minus 98. This 5, or let me put them all in decimals, 4.72 is your total loss. On a portfolio of 100, why 100 only? 85 stock plus 15 cash. This additional Nifty futures 100 is a derivative contract. That is, the contract returns are part of the portfolio. There is no underlying asset for it which you have. Right. So it goes in the numerator, does not go in the denominator. So 4.72 is the loss. How did we get this 4.72? Because we knew that the Nifty futures fell by 2%. How did we get the 2%? Because we computed 3.2 by 1.6. What is 3.2? The change in the value of the equity portfolio. Had they asked us to compute the change in the overall portfolio value, that is, what did they ask? Portfolio beta after 3 months if the trader on current date goes for long position. They only ask for portfolio beta. So we can actually end the problem by saying beta of portfolio is this. I can probably cut and paste it here if you want. Okay, beta of the portfolio is 2.36. Very, very simple problem. Need not complicate or break your head on this. Okay, fair enough. Now let's move to the next problem.